Welcome back to Benzinga Live, everybody. Happy Thursday. Doesn't really feel like a happy Thursday, though, with the markets continuing to move lower. We will talk about that. We will talk about retail investors now being more bearish than at any other point all year. Yes, even when we were at the lows back in June, retail investors are now more bearish, and there are less bulls. So not just on the bearish side, but also, you have a lack of retail investors willing to go long right now. Quantum in the chat saying SPY going straight to 372. We'll talk SPY charts. We'll talk Qs. We will be joined by Steve Kalasian here in about 13 minutes. So excited to get Steve on. In the meantime, let me know what you guys have been trading. What stocks y'all have been watching. We'll go through some of our top headlines on Benzinga.com today. Without any further, let's go ahead and roll that intro, and we'll be back.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a breaking news.
Alrighty, y'all. Let's go ahead and start. Let's bring up my Benzinga Pro. Ooh, this is not what we wanted to see. The S&P 500. And I wanted to talk about exactly where we got to last time. And here, I'll go full screen on this chart just to... I'll go full screen on this chart here just so we can really see some of these lines. So we got down, I want to say 363 was the exact number we hit back in June. Let's double check. Let's fact check me here. Fact check. Looks like the low was 262.17. All right, we're at 374 right now. 375, we'll call it. Round up. We're not that far off. We're not that far off the lows that we hit back in June. And yeah, it's certainly not a great sign. There have been a lot of things that have happened in the last 6 weeks, 2 months or so since we hit those lows there. There was a time during this rally here from June to August where it looked like, and for a lot of people, it looked like maybe it was possible that we were seeing inflation come down while the labor market stayed hot, and that some sort of a softish or softer landing was possible. And that notion has kind of gone out the window, right? When we got that hot CPI print a couple weeks ago that showed, hey, inflation hasn't peaked. Really core inflation, a lot of things that are hard to like rent, energy prices, all these things had continued to increase, and increasing at a pretty a pace that was faster than I think a lot of people felt comfortable with. So now we're seeing the market reaction to understanding that the Fed really has no other option to do other than what Powell basically said it's going to do yesterday: raise rates enough to bring unemployment higher, that eventually inflation will fall. That's not good news for basically any company in the S&P 500, right? Even banks that people say benefit from higher interest rates have already come out and basically said, yeah, this is going to be a problem for us too. And we'll look at the financials. We can look at the XLF right here, and you can see right here, right? It's not like banks or some of these financials. We'll go to Bank of America. We can go to JP Morgan and see. I mean, you can just tell from the market reaction. It's not like people are going, oh, high interest rates are good for banks, let's go buy these stocks. No, these stocks are back at their lows that we were at too. JP Morgan was at $170 October 2021. We're at $111 right now. And this is a stock that pays a pretty decent dividend. A stock, JP Morgan, probably not going anywhere, right? So if you're looking to add some companies that provide you a nice dividend yield, could be one. I mean, obviously, you don't want to touch JP Morgan or any financial stock for that matter if you think there's a big financial crisis-esque, type recession coming or something about to happen. But yeah, I mean, Looking at JP here, dividend yield 3.6%. I mean, look, there's no reason right now. There's no reason to buy a dividend stock just for the dividend if it pays less, if the dividend's less than 4% right now. Because that's what the risk-free return of going to buy bonds right now is. 4%. And for a lot of people that are losing, 10% of their portfolio a month or 10% over the span of a few months, 4% sounds pretty good, right? It means if you buy $100,000 worth of bonds, right? It's a free $4,000. Where's Mike? Shelley's asking. Who are you talking about? Easy Mike? I don't know. Where's Easy Mike? We did have a little break in the action today, I know, from live trading to Benzinga Live. So thanks to you guys who did stick around through that gap. Again, if you're just joining us, we will have Steve Kalajian joining us here in a few minutes. We'll be talking about all the stocks that he's been watching. And then after that, 9% on I-bonds, but only 10K limit. Yeah. Look, I mean, also, I don't know how I-bonds work. I'm pretty sure if you buy I-bonds now and inflation doesn't rise from where we are at now, I don't know. I'm not going to say anything because I don't know how those work. So, but yeah, either way, if 10%, we'll call it, is the most you're going to get from I-bonds, and 10K is the most you can invest in them, I mean, it's $3,000 potentially, but I don't know if it how life-changing or exciting that is for a lot of people out there. All right, guys. And then after Steve Kalajian, I'm hoping we get Mr. Hot Stocks Luke on around 12:30 or so. Checking on some of wait, you have to hold for 5 years on an I-bond? Or is that just on the what is the so do you just have to buy like a 10-year bond to get the 4%? 2-year bond? Yeah, 2 years 3.86 per. Oh, whoa. No. 2-year yield is 4.1. So this shows my complete utter lack of understanding of the bond market or how these treasuries work. So I hope someone in the chat can set me straight. Is it total, like if you buy a 10-year bond that offers like 3%, is that annual or total? Go to the website. I don't even know what website I would go to. treasurydirect.gov. I-bonds can be purchased through October 22 at the current rate. The current rate is applied to the 6 months after the purchase were made. For example, if the I-bond is purchased on July 1, 22, the 9.62% would be applied through December 31st. Interest is compounded semi-annually. It is annual. So, I mean, if you buy, like if interest rates gets up to like 5% for a 10-year bond and you buy bonds and you get paid 5% annually on that money, like that's not nothing, right? That's like decent returns, I think, if you get 5% a year for 10 straight years. All right. What interest will I get if I buy an I-bond now? The composite rate for I-bonds issued from May 22 through October 22 is 9.62%. This rate applies for the first 6 months you own the bond. So what rate applies after? Okay, the interest on I bonds is a combination of inflation rate and fixed rate. Yeah, it's cool how they lay out exactly on this website. This is from treasurydirect.gov, which it doesn't really look like a government website. Like this logo looks kind of, it looks like a, this looks like a website straight out of like 2008. Like post.com bubble, post like that internet, but 2008, this looks like a forum I would go to like in the mid 2000s figure out how to fix my iPod Nano or something. It doesn't really look like a government website. But hey, I'm curious. All right, let's just go to Treasury bills, T-bills. T-bills are typically issued at a discount from par amount. Something that so I read The Big Short a couple months ago, actually, and one thing that I learned in the book, which I don't know if this is, I assume it's still true. It was true in the in when the book was written, I guess in the mid 2000s or I guess in like 2010 or something. But that the bond markets, there's like way more money actually in like the fixed income world than in the equity markets, like total on Wall Street. I didn't know that. I don't know if that's still true. Total money in fixed income market. Size of the bond market is estimated to be 120 trillion. That was as of 2021. So that's worldwide 120 trillion. Total money in the public equity market, I guess. The total market cap of the U.S. stock market is currently I don't know. Anyway, it looks like that's still true. I don't know if it is. I'll fact check that. Get back to you. But yeah, basically was that the fixed income markets actually dwarfed like the public equity stock markets in terms of total money out there on Wall Street. I don't know if that's still true. All right, guys, it is 11:45. I see our first guest hanging out in the background. Let's give our most zinger welcome to Steve Kalasian, joining us with probably the best setup out of anyone that we have on the show. So without further ado, let's go ahead, give Steve our special intro, and bring him on the show. Mr. Steve, how are you doing today?
Hey, Aaron. Good morning, everybody. How are you?
I'm good, man. I mean, markets could be better, but it is what it is, and I think we've known what we're in for here for a while. So yeah, man. I mean, nothing new on our end.
Yeah, last time we spoke, it was right the day of the the CPI number, right? And S&P has hit that 4175 level. And I just kept on showing you on the graph, we're just constantly making lower highs. And I thought, based on the pattern I saw in the daily charts, the market was headed for trouble. I was definitely looking for below 3,900 on that move. You know, we got this pushed down right here to the 37. Here's a real question. Are we going to make a new low, or are we going to hold above that 36.39? And we're not even into October yet, you know, which is a really, really bad seasonal time for the markets. Again, this really didn't have to be like this. The Federal Reserve, said they're going to try to get their inflation targets down to 2%. I mean, I was reading some things here today that were mind-boggling to me, based upon a statement that was written by them, a few months ago. And, somebody actually brought this to my attention, and I was just like really super blown away by it. They maintain that, I'm going to try to find it here. I think I took a picture of it, but, it says here that, this was about about a year ago. The rates will remain lower for longer. They're unlikely to raise interest rates until 2024. We believe the recession is unlikely. Inflation transitory and not a problem. Inflation should fall to 2% in 2022. Well, we had the highest inflation in 40 years. And they just completely ignored their 2% mandate and watched it get out of control. And when the Dow was making new highs, I was jumping up and down. When the S&P hit that 4,800 level, I was jumping up and down and just telling all my good friends, I wouldn't own money. I wouldn't own any shares here at all, period. I think they're going to do something drastic here. And look what they did. They dropped 1,200 points off the high back in June. And, this is, again, just completely, now that there's potential looking at the Fed, hikes going forward, another maybe 1 3/4 going out. So you already have the highest interest rates on mortgages since 2008. This is just going to cripple the stock market and cripple the economy, what they did here. And there's no accountability or anything. And, I don't know. You could potentially see the S&Ps at 2,800 next year before a new bull market sets up. And I was showing everybody last night some technical work I do on a longer term scale based upon the monthly. And one of my indicators I look at is if you do the calculation, goes out to the end of the second quarter to the beginning of the third quarter of next year. And that would be the first time that number got to that level since 2008. So 14 years ago. And that's when I think a new bull market's going to start.
Yeah, and I know a couple weeks ago we were talking about, I brought up the AAII sentiment survey, and you said, maybe when that number of retail individual investors gets to like 60+% bearish. We did just today, so in the week ending and yesterday, hit a new 1-year bearish high. So 60.9% of individual retail investors surveyed were bearish. Only 17.7% were bullish, so less than 1 in 5 investors surveyed. With that said, I don't see this as like a screaming buy signal that now is the time, but as we keep moving lower, and if we know sentiment follows price, if we see this number continue to increase, eventually that's going to help sway me, be like, okay, if 75% of people are bearish out here, someone, I'll eventually start nibbling at the longs that I like, the individual names that I know will be able to withstand a year of higher interest rates, or as unemployment's rising. Okay, I know, these companies will be okay in the long run, and I'll start adding to those positions.
This is just a number. When we talked last week, it was in the mid 50s, right? And I said I would start alerting myself. I mean, right now we're about 190 points away from my moving average on the daily charts, which means you wouldn't surprise me and you get a bear. I told you, bear market rallies are more vicious than bull market rallies, and I wouldn't be surprised again if we push up and then make lower highs. I mean, just look at the lower highs we've made here on the graph that we looked at last week, and basically when you do this, you work off these oversold conditions. Maybe they rally 100, 150 points from here off the lows to work 180, 200. But again, either way you look at it, the Federal Reserve is maintaining that there's potentially another 175 points to the upside on interest rates. This is going to cripple stocks. And I won't own anything until I feel that they're at a level where they're done. And then that's going to be a capitulation to the downside. And that could bring us between the 2,800 and the 3,100, 3,200 on the S&Ps. I'm thinking more the middle 3,000, 2,900 range. And that's going to happen, I think, sometime next year. I always said that the market is going to really take the toll in 2023. But again, this is complete, ignorance that I am dumbfounded. I am just completely dumbfounded as a trader, as someone who owns a home, someone who is very astute. I'm not a fundamentalist by any standards. I'm a technician, but just taking a step back and just looking at the academic view that how do you allow inflation to go way past your 2% mandate go to a 40-year high, 8.5%, 9% range, and you don't do a damn thing about it. And then you just want to put the brakes on and caboose everything and then start taking this aggressive stance when you could have taken an aggressive stance probably when it just ticked above that 2%. They completely ignored all the factors. I mean, people were jumping up and down. News organizations were posting how high lumber got, how high milk got, gasoline. You have to be a rocket scientist. So I was paying $225 a year 2 years ago. I'm paying $455, $550, and and even with the gasoline and oil coming down now, you still have a high CPI number, and that's scary though.
Yeah, I mean, I completely agree. I think it is, frustrating that we've gotten to this point now where it's either like, okay, people have to tolerate high inflation that isn't acceptable, or we're going to have to raise rates high and fast enough to jack up unemployment and maybe even crash housing prices in the process. And it's like, okay, like, it is, we're in this position now. I mean, we went through
I know, but that's the thing. This could have all been avoided. You know what I'm saying? This could have been avoided if you had a Federal Reserve that saw the numbers. I mean, and like the everyday people were seeing, right? And if they're going to,
I mean, I 100%. I think the 07, 08, financial crisis. Looking back on it in hindsight, there were a lot of things that could have been avoided too had there been more regulation in the banking and housing, and all these things.
You were giving hedge funds and 30-to-1 leverage, and then the day, I never forget as long as I live. I mean, I could remember like it was yesterday when Bernanke came on. I said that the subprime markets remain contained. I was like, what is that? And then 3 weeks later, we just crashed.
Right. And I think my point was just that I think looking back in hindsight, basically every, crash or financial crisis, looking back on it in hindsight, it's easy to say that could have been avoided. But I think our nature, and you've been doing it longer than I have, but I think the nature of us, I guess, as people and the nature of financial markets in general is that you go through this cycle, people get too greedy, over leveraged, and then a correction happens, and then it starts again. And we probably, we'll see this happen again in 20 years or whatever it is.
I mean, look, that happened 14 years ago, and I think I think they're smart enough now not to do the over leverage thing. But here's the thing, right? If the Federal Reserve's main objective is to monitor inflation, then why, when it got above 2% and they saw the numbers, they didn't do anything then when the Dow was making new highs, right? And that's the $64,000 question, that they could have done this gradually, and instead of coming out like gangbusters the last 3-4 months, you know what I'm saying, 5 months.
Wait, why 64,000? Because that was the price of Bitcoin?
Oh, the $64,000 question? I don't know. I just came up with that. I don't know.
No, I think there's some old game show that has a title like that. But yeah, I mean, I don't know. I think there are answers to that question. Why in that exact time frame the Fed wasn't in a huge rush to start jacking up interest rates, and again, I agree with you that the Fed has made some bad decisions that have led us to this point. But on the they do at the end of the day have a dual mandate, not just inflation, and at the time unemployment, still wasn't back to pre-COVID levels. And on the inflation front, I still think this holds true today. You are seeing a lot of inflation driven by supply side problems, right? I mean, even look at rent. The reason rent's so high is because I'm looking for an apartment. There's like 3 available ones around me. Like there's not a huge supply of housing for people. Mm-hmm. So or energy, so I do think it was an idealistic position that the Fed took, thinking, okay, maybe we can, get away with trying to keep rates lower and some of these supply side issues will fix. Obviously, that hasn't been the case, right? Mm-hmm. So now they're trying to backpedal and do these things retroactively instead of getting out in front of it, like you're saying we should have done.
A lot of government spending is also driving prices up and things like that. So, let's. I think also, but again, when the Dow was making new highs, and the only thing I just kept on thinking to myself is the way to combat inflation here is to have higher asset prices, and that's why the Federal Reserve didn't react. That they were happy that the markets were like capitulating to the upside, and that okay, if we have higher asset prices, well, that should offset the inflation numbers. But however, not everybody's in the stock market, right? A lot of people don't have money to be in the market, but are still taking on the chin on the inflation, level on products and things like that. So I don't know. I wouldn't want to be in their shoes. I mean, I just think that the market's in trouble here. We may get these wild, vicious bull market rallies and bear market rallies and think that, everybody's hunky dory. But ultimately, I think they're going to get completely cabooshed in the next 6 months.
Yeah, I mean, I agree. I don't think we're in for any sort of, like you said, bear market rallies can be more vicious. We might see some of those days, but I don't think anything will sustain as long as the Fed is on this course. RS is asking, do we talk individual stocks? Yeah, man. We can transition from talking more instead of more overall macro thoughts, moving toward individual stocks. RS, if you've got any names you're looking at, any names you want to look at, just drop them in the chat and we'll take a look.
Yeah, absolutely. I mean, I think also the fact that, when you start seeing analysts start cutting estimates, that's the sign that, the analysts are bringing down their numbers. And if they do it, I think the rule of thumb is if you see an analyst cut numbers by 3 times, you're going to be at the bottom. I've experienced this twice in my career. When they say, okay, we're going to bring IBM's earnings down. Okay, we're going to lower expectations. We're going to cut them again. We're going to come in again. Then the third time, boom, that's the bottom.
Yeah. All right, I'm just catching up on the chat here. We do got some tickers flying. Let's start with Tesla from Patrick Canoy.
Mm-hmm. I think Tesla, obviously, you have to split. I think if Tesla can pull in between the 235 and the 255 range, I think it's worth accumulating. I think it's a sound company. Again, fundamentally speaking, I'm seeing more Teslas on the road now than I ever have. I mean, I literally, when I drive, I'm seeing a Tesla here, a Tesla there. I know like BMW and other companies are coming out with their new versions of electric cars in 2024 and 2025. I think it's a sound company. I think that people are always going to gravitate to it. I think they don't have. I think if we do get any weakness to those levels, I think it's a buy and hold for the future.
Yeah, I think with the way the overall market is, right, I wouldn't be buying Tesla anytime soon.
No way.
But if it gets down here where we bought, when we got to
where is that level?
200, almost flat back in June. Yeah. Well, this is I don't think we had split yet, so I think it was I think maybe 600 flat or like 660 down.
You got good support, good base. Even if you go all the way over to your left, you got good base and support here. So that 200, maybe 200, 235 level.
Yeah, this one down here where I'm at now is 183. So if we do break below this 200 level, 183 could be one to watch. But yeah, that's
going to bring the S&Ps to 2,800. Trust me.
Yeah, which I think that's kind of the bear case right now for me. I think I'm looking at SPY at 280, 290. That's if the Fed follows through and you see unemployment starting to come up. And at that point, I'd be willing to go fully long there at the SPY at 280.
Agree. And again, if you, like I said earlier, if that happens and we we get that number that I looked at, that happened back in September and October of 2008, that would be the first time in 14 years, and that's when I think a new bull market will start.
Yeah.
Off my monthly chart.
Yeah, and I'll go back to SPY real quick. And again, if you have any individual names, but we basically bottomed out at 363 back in June. Going back to 280 would bring us back to about this level. So about like halfway down where we got on the COVID crash in March 2020. You can see there on the V-shaped recovery. So not quite to COVID lows in March
Was it
2020.
that low on the S&P right there? I can't see it. It was a
From the COVID lows?
Yeah, it was a COVID low on the
220.
Wow. So 2200.
Yeah, that's a ways to go. I don't know if we're getting all the way down there. That'd be pretty bad.
I mean, you have mortgage rates at the highest in 30 years. I mean, I'm just saying I think 2800, is reachable. Now, again, how many times I've been in the market where it blows through certain numbers and then you'll get upside and then downside, and then you get that that bottom. You know what I'm saying? It could retest that low, 2200. I'm not saying 2800 is the ultimate. I'm saying that was my target, 2850.
Yeah. No, I agree with that. I already, 2900, 2800 have been levels that I've been as we've gone through this latest downturn. Assuming we blow through the June lows here in next week and the week after that, then that is the next level that I'm eyeing. And again, that's the kind of bear case for me. I think a bull case would be, here in the next 3 months, if we see, maybe inflation has slowed down and we would need to really, we would need to see CPI go from like 8 to, 7 to 6, like really show some meaningful digression there.
Mm-hmm.
And then potentially maybe we could bottom out a little bit before that 2900. But as long as the inflation numbers are coming in hot, forget about it. 2800, 2900 should be where people are looking, not anytime soon.
So even if we take out a new low for the year, the 3639 on the S&Ps, even and let's say you blow through that, you get down to like 3580, you're going to ricochet up to like 3900 for an oversold bounce, and then I think again lower highs, and then I think you'll eventually push down into 2023 into that 2800 level.
Yeah.
By no means are we in a bull market. You know what I'm saying?
No, not by any means or not by any means at all. So, going through some other tickers we've got in the chat. Urban wanted to look at SPY. We just did that. Let's see, Microsoft from Quantum. Let's look at Microsoft. I haven't looked at this chart in a while, actually.
Well, Microsoft, believe it or not, is up $2 on the day, bucking the trend. I think if Microsoft gets down to the 165, 175 level, I think it's a name that I would accumulate there for long, and that
so,
again.
I guess the question is like all these names we look at, right? We look at Tesla, Microsoft, we look at the S&P 500, right? You're gonna be kind of bearish on them, but are you trading?
We're in and out. Actually, Tesla and Microsoft, the names that we're in. We look at each and every day on my live channel all day long.
So you're actively shorting these on a day-to-day basis?
Like today we had a big buy divergence around I don't know, right after the opening, and now I'm getting I think the lows are in for the day on Microsoft. Just looking at, I'm going to get a pullback here to try to get a nice little trade out of it on the long side. But it doesn't mean that you can't trade it. You can, just because you're on a downtrend doesn't mean you can't get buy divergences. You know what I'm saying? And for some pretty good moves.
Yeah. I mean, it's just hard, I think, for a lot of people. Like you said, we were talking about how the bear market rallies are more vicious. I think a lot of retail, if they do decide eventually to actively short, buy puts, whatever, you get people that get caught in those vicious rallies. And
you get decimated.
Yeah, and you end up, I mean, that's what bear markets do, right? Bears lose money and bulls lose money. You can't make money going short. It seems like you can't make money going long.
Yeah, I mean, I'm going on my 40th year, and I've told people from all around the world that bear market rallies are more vicious than bull market rallies. I mean, they'll just destroy you.
But are you so have you found like a strategy or something that helps you play those rallies in a bear market, right?
Oh yeah, you look at the indexes, like for example, like the SPXUs, the SPXLs. You look at the TZAs, the SQQQs, the TQs. You use the ETFs that follow the indexes, the TNAs, the SDAOs. These names are monsters. The UPROs, these are names to trade if you're going to look for market direction.
Yeah. So Slinky's asking a good question. With that said, so while we've got Microsoft up here, you're saying if it gets down to 175, but you're already saying you're in and out of it every day.
If the S&Ps get to 2,800, then you're looking at 165, 175 on Microsoft. If you're a long-term investor, I'm saying.
If you're a long-term investor, right? That's what the question was. So
Yeah.
what are you talking about with 175? Is he talking about a long-term investment there?
Yeah, I'm saying if the S&Ps get to my number 2850, you'll see Microsoft at that number.
Yeah. Another stock people want to check out is Adobe.
Got pretty beaten up. Wow, look at that. Unbelievable. Really got cabooshed here. Not a name that we look at or trade. But again, they're gonna cut their rate. The analysts are gonna just cut their expectations on these names, and that's what's gonna propel the market to fuel to the next bull market. Because after they cut it once, they cut it twice, they cut it maybe a third time on the earning expectations, then Microsoft beat, and then boom, next thing you know, this one beat, boom, the earnings get so compelling because they've lowered their expectations on the earnings, but we're nowhere near that
yet. Yeah. Kevin's asking, can we briefly discuss screener techniques, strategies to find tickers to analyze? I know Steve has a name of a certain number of stocks that he's just looking at basically every day.
Yeah, we trade the same names every single day because the research I outside the indexes, we'll get 4 to 6 great patterns or strategies every single day on the same name. So that's pretty damn good. I'm actually building something in Trade Easy, hopefully in the next 4 to 5 months. That is a screener I had that really can pre-sort the types of conditions on names. So I'm excited about hopefully that gets launched in the next 4 to 5 months. That's really based upon pure mathematics. So I'm really super excited about that. That you can just click a button, boom, and then you can pre-sort everything based upon the rankings and the type of conditions they're in. So I'm excited about that. But up until then, that gets launched, we look at the same names every single day, and people are really happy. As my father once said, I'd rather be great at one thing than good at many. There's no reason to be like jumping around. Like Win had a big day yesterday or 2 days ago, and a couple guys like, Steve, let's look at Win really quick. I'm like, I'll look at it, but let's just stay focused on the names that we trade every single day that have the monster moves, like the Goldmans, the Nvidias, the Microsofts, the Apples. I mean, names like that. AMD does about 100 million shares a day. So there's no reason to, flip-flop into different names when, Win may had great long patterns, but we're capturing great short patterns on AMD, so.
Right. Yeah, and I think it's like anything else, right? Once you get familiar with a stock, with its movement, you're going to feel more comfortable with it than if you're just trading something that you just found out that day.
I mean, not that when we actually, on the pullback on Win, we actually called the long on it. Some people jumped in on it and ran like $1.70 on it. But I mean, okay, granted, the strategy worked out great, but I'm not the type of guy to jump around all day long. I'd rather my screens are set. Like if you turn the monitors off, though, you could see the symbols embedded into the black screen. There's no reason to keep jumping around. There's more than enough volume on the symbols we look at. You're looking at probably 3 billion shares combined on all the symbols.
Yeah, it's incredible. There's too many. There's too many to track all of them, right?
Okay,
just five.
So this stock is up 5%, 8% for the day. I'm going to flip what I'm doing to go look at that now. There's more than enough to be made here.
Yeah, 100%. I like examples like AMD, like you gave, Goldman Sachs. These are names you don't want to be stuck trading something that doesn't trade that many shares a day, or maybe even worse, a stock that usually doesn't trade that many shares a day, but then the one day everyone's talking about it, now the volume spiked up and it's harder. It's going to be harder to trade.
Yeah, so you get a gigantic spike in volume one day, and the next day it just goes absolutely nothing. I mean, look at Boeing. How do you not trade a stock like Boeing that does 50, 60, 70 million shares on a day? How do you look at a stock like the QQQs or the Spiders that do 100 million shares a day? There's more than enough volume to go around in these names, and that you can trade and make a living versus jumping around.
Yeah, 100% agree. All right, well, let's see if we've got any other final kind of questions or anything while we have Steve on. If not, we've had you on for about 25 minutes. I'll let you get back to trading, and it's always a pleasure, man.
Aaron, great to see you. I'll see you next week, brother.
Sounds good, man. All right, guys, if you want more from Mr. Collision, tradeeasy.com. I'll go ahead and drop that in the chat. Again, tradeeasy.com, 2 E's on Trade Easy. But Steve, always good to get him on, hear what he's got to say. All right, guys. Sorry, just catching up on the chat here. Uh-oh. Blocker. Got a block. We got a code red in the chat. Block user. Sorry, guys. Sorry you guys had to see that. Thank you, Mr. Collision. All right, guys. If you guys see me using what I'm using right here, this is Benzinga Pro. Every single thing you could need as a trader. Look, you can even link your brokerage now to your portfolio. We have different preset workspaces, unusual options activity, earnings monitor, analyst ratings, what's moving, pre-market, swing trading, momentum trading, day trading, all these different presets for you. What I typically have open is the details tab, which allows me to go to any stock, right? Say Tesla, pull it up on the details page. I get the current ask bid right here. Previous close, open, some kind of just stock quote data, key data, 15-day moving average, key range, what's the float, what's the short float, what's the short percentage of the total float, what industry is it in. You've got some good fundamentals here, talking PE, price to sales, EV to EBITDA. You have peers, earnings, news. So your details tab is really one that gives you like the most comprehensive. And then you can go straight into the chart based on here. But in addition to details, right, we could pull up the movers. See, okay, in the regular session, in the whole session, what's the biggest gainer of the day? Well, that would be Sparrow Therapeutics, up 205%. So if all you want to do is try to find a runner for that day, maybe you want to get in here and short it when it's up 200%. I don't know what you're trying to do, but you can do it here. I'm going to go ahead and play this little bumper we have for Benzinga Pro. Pro.benzinga.com. Free 2-week trial. Pro.benzinga.com. Free 2-week trial. No credit card needed. If you use it out and you like it, you can shoot me an email at aaronbree@benzinga.com. We'll drop that in the chat as well, and I will hook you up with the best rate that you'll be able to get on Benzinga Pro. So again, watch this bumper real quick, and if you guys have any questions, let me know. Oh, we even have a special. This is awesome.
Did you know nearly all stock price changes of 10% or more result from a single news headline? That's right. News headlines have a unique ability to drive stock prices up or down. These news catalysts create trading opportunities every day. All you need is a little help to reach out and take them. And if you're looking to grow your portfolio, it doesn't matter if your investment budget is small or big. An easy-to-read stream of news headlines will increase your opportunities to profit from price changes in the stock market, consolidate a knowledge-based investment strategy, and grow your portfolio. All you need is Benzinga Pro and its powerful news alerts, price tracking, and portfolio monitoring to make a positive change in your trading performance. We've already helped thousands of retail traders across the world, and they could not be happier. Increase your market knowledge, boost your exposure to big movers, and make informed trades before major price changes. The opportunities are all around you. Subscribe now, and we'll skyrocket your portfolio today.
Quantum, that is a great question. I'm not quite sure. I'm not the biggest technical trader, so I'm not even really sure exactly what that is. But on the charts, we're integrated with TradingView. So I assume so, because TradingView is pretty advanced when it comes to everything you can do from TradingView. Oof. Market just took another little turn down. VIX is optionable. So the VIX technically is not optionable. There are different indexes that track the VIX that are optionable. VXX is your short-term futures for the VIX. I believe that one is optionable. UVXY is the one that like goes crazy sometimes. I believe that is optionable. I would do VXX. I think that is the short-term futures. I think that's the one that like most directly tracks the VXX. Or sorry, the VIX. Right, like it says the VIX is up 0.1% today. The VXX is up 0.9%. There are a couple other ones. UVXY is the short. Oh, I guess UVXY is pretty similar to VXX. I think they're just from different. One's from iPath, one's from ProShares. I would see out on the options market which one is trading more out of VXX, out of UVXY. This is weird. I mean, you would think it's like, I think it's kind of weird to me the VIX isn't higher right now, right? Maybe because there's so little uncertainty. It's just like everyone's pretty, like the volatility is almost low in a way, right? Because it's just moving straight down. Usually, typically, when the market's moving down, you see the VIX spike higher because it's increased fear, increased uncertainty. But right now, I think maybe why you're seeing the VIX not spiking is because it's not really any, big uncertain event that's causing the market to go down. It's just, oh yeah, the Fed's hiking. Don't fight the Fed. Stock returns will probably be subdued over the next 6 months to a year. So it's not, it's not like a Russia war or COVID situation, right? We can look back on this chart here and see really the crazy. There was a recent, I know there was the day like a long time ago, the one thing went crazy, but what was the thing recently, like 6 months ago? What was the thing like 6 months ago with one of the VIX ETFs that went crazy, or well, shoot, it's escaping me right now. The bank, whatever bank was like, I can't remember. Let me just try to find it. VIX fund collapse. I see that was different than. There was the Volmageddon in 2008 when the VIX or the XIV flamed out. There was something like recent where one of these funds like went crazy in a day, or something else. I can't remember exactly what it is. Yeah, no, and that was the big one, was in 2018, that Volmageddon, XIV collapsing. But again, there was something I want to say about like 6 months or so ago where, let me look at just what the charts on these UVXY. It was one of these ones that just like went crazy for a day, and then the bank behind it had to come out and say they were like backing the security. I don't even know. PMH was 1570. What's PMH? That's not it. Guys, I don't know. Like, as far as stocks that are actually interesting right now, like on the long side, I don't know if there are a lot, to be quite honest with you. SQQQQ, maybe? UVXY. Yeah, I mean, these spikes were from like Russia, Ukraine, I'm pretty sure. Boom, boom, June when the market was going back down. But see, that's what's crazy. Is like we're back to the lows that we were at in June, basically. Not exactly, but pretty damn close on the indices, on the SPY, on the Qs, but we're not close to the VIX being where it is. I think if we were going to see the VIX spike up, it would need to be we would need to start seeing some like capitulation in the sense that like some funds are having trouble staying well capitalized and like things are looking like they're actually starting to break. Right now, it doesn't look like anything is necessarily breaking, just that there's kind of froth and stuff being taken out of the market. Of course, there have been industries, primarily the crypto market, where things have started to break a little bit, but not yet. And we'll see. I mean, that's I think what a lot of people want to figure out is there going to be something that is going to break and give us a 07, 08 type of market correction around the world, or is it just okay, we're going to be, you know, kind of stuck in this no man land, stuck in this period of worse returns over the next 6 months to a year until that market turns around. LMT looking strong. I mean, certainly stronger than other stocks. I don't know if I, you know, am going to come out here and buy this. And here's the thing is, and I wanted to talk about this too, and we'll go back to Lockheed Martin because Lockheed will probably be in a different position than a lot of other companies out there. But looking at stocks like Microsoft, right, where you might see the forward PE dipping below 25, right, or even a company like AMD where the price to PE is 15, the forward PE, the price to sales is under 5. All these things are showing that, yeah, this thing is like historically cheap for AMD, historically cheap for a growth stock that's set to keep growing. But what you have to understand is these ratios are being calculated based off of earnings that have already happened. So if AMD's earnings are way lower, the stock will come down, which should help the ratio, but the earnings won't be the same, right? The earnings right now, and we can look, we'll go here to the financials. So let's go to income statement, total revenue. Look how much the total revenue has grown over the past 6 quarters. From $3.5 billion to about $4 billion to 4.3 to 4.8 to 5.8 to 6.5. So in 6 quarters, you almost doubled from 3.4 to 6.5 in 6 quarters. So if this contracts, if this number, the total revenue coming in, the earnings coming in starts to depreciate, starts to come down, again, the stock price will come down too, which will bring the PE maybe lower, but depending on how much the stock price comes down, the PE will be set to come down as well. So just because it looks cheap now, depending on the earnings coming out, doesn't mean it necessarily is that cheap. Shelly's saying all PEs will go down. I think yes and no. I think there will be some companies that the stock price gets hit harder proportionally than the actual, you know, decrease in earnings. So you might see some stock where the quarter, you know, is down 20% from the previous quarter, but then the stock goes down 25%. And in that scenario, the PE would actually, well, actually, yeah, in that case, the PE would go down. But so I think the reverse is true too. I think some companies will have their earnings go down more than the stock actually goes down, and that would make those PEs go up, right? Because then you would have a higher ratio of earnings to price. I feel like that didn't make sense, but it made sense in my head, which I think is all that matters. All right, we'll go back to LMT real quick. I don't know enough I this is just what I'll say. I feel like if you're long LMT here, you're long the bull case here essentially is that not even just in Russia and Ukraine, but kind of a lot of these conflicts globally start to escalate, which I think a lot of geopolitical experts have anticipated, right? Because you have this sort of, you know, kind of, I think, pent up animosity, like around, again, like I'm not just talking about Russia, Ukraine, but, you know, China, Taiwan. There's a lot of these geopolitical situations around the world that could be set to escalate in the next, you know, I don't know how long, 6 months to a year. So if that happens, Lockheed Martin could be in like set in a big position to benefit from that. But again, you know, the flip side of that is true. The bear case, I think, for Lockheed Martin is that if you've seen, we've kind of been on this path, it seems like, toward doing less, you know, drone strikes in the Middle East, all these things. And if you have some de-escalation in these places, I don't know how much, you know, Lockheed Martin is like, are they increasing contracts right now? Are they decreasing? From the numbers I've seen, it seems like the current administration has been actually like using drones and things like that less than the previous two. Again, I don't know, again, how, I'm not a geopolitical expert, don't pretend to be, but I don't know if going long Lockheed here is my play. The Fed wants to break something, either employment, the housing market, currencies. See, I think here's where I kind of disagree with this statement, where I don't think the Fed necessarily wants to see everything or anything break. I think kind of like what Powell was saying yesterday was we want to see unemployment, or I don't even know if he said we want to see unemployment come up, but basically that they're willing to tolerate that. So if unemployment starts to come up to, you know, 3.5%, 4%, 5%, and then at that point, you know, some spending power has been taken out of the market, inflation starts to come down, and then they start to kind of reverse, cut rates, unemployment starts to then come back down. I don't know if looking back on that, we would describe that as like the labor market breaking, but we'll see. We shall see. They don't have a clue, AB. All right. Special treat. We should have Mr. Luke Jacoby joining us any minute now. Till then, we can do some ticker time from the chat. If you guys got any stocks. Okie dokie. STEM. It's one I have not checked out in a while. STEM. Whoa. Big red day today. That big red daily candle. How's let me just check in how the market's doing right now. 5-minute candle here. Question is, have we bottomed on the day on the Qs? What do you guys think? Give me a 1 in the chat. So Qs at around 11:25 right before we started the show. Hit 278, 279, we'll call it. We're at 280 right now. We got a little bounce here. Have we seen the bottom? Drop 1 in the chat if you think, yes, we have seen the bottom for the day. We will continue to either move higher or stay neutral from here. Put a 2 in the chat if you are intraday bearish, think we're going to come back down and pass through this previous level that we hit at around 11:30 a.m. Eastern. Going back to STEM. Don't think I forgot about you. I did not. I would never do that. We are looking at STEM right now. First thing I'm going to do is I'm going to see what the hell this company does. STEM is a provider of energy storage systems. Cool. The company bundles third-party hardware with its proprietary Athena software to provide customers a turnkey solution. You got to love turnkey solutions, am I right? All right. Down 7% today. Let's see why. Shares of several companies in the industrial sector are trading lower amid economic concerns following Wednesday's Fed announcement. Increased interest rates can potentially lower economic activity, which could impact industrial companies. So yeah, there you have it. Interest rates coming higher, bad for this company. Go figure. This stock was a $50 stock in February 2021, came down, hit lows of $7. Since been moving higher and honestly looking pretty good until this move scares me. It looks like we've got a ways to go to the downside to me, unless we can hit this resistance level and start coming back. But to me, I'm not buying this one today. And then, yeah, what else did, let's see, who asked about this again? Kevin. 10 and 50 moving average, crossed the 200 moving average. All right, Kevin, were you looking at this as a bearish trade? DG saying, so they will put people out of work, then print more money to support them on unemployment. Brilliant. That's going to worsen inflation. Yes and no. I think typically people earn outside of during the beginning of COVID, people earn less money on unemployment than they do working typically. So that would decrease spending power across the board if that is indeed what ends up happening. All right, guys.
Boom.
Boom! Do you like that little trick I did?
That was nice, but my microphone isn't on.
All right.
Is
AT is going to get your microphone on. Here in
All
the
right.
next. There we go. It's on.
All right, there we go. Now we're live.
Guys,
Yes, I did like your little camera trick. A lot to talk about today. We'll lead with, I'm officially calling it. It is fall
the
in
bottom.
Michigan.
Oh. I thought you were
We're not
officially
calling the bottom. Nope.
Okay.
Absolutely not calling the bottom.
Can you call when
We're
you,
nowhere near the bottom.
No, I'm not saying we are now, but when you're ready to call the bottom, can you come on here and do it publicly?
Yes.
Okay.
And I will at some point call the bottom. Absolutely. I will.
I'm preemptively calling it at. I don't think we're gonna get down to the 2,900 level on the SPY that people are talking about. I think we're gonna get down to 3,300. It's my guess.
Yeah, I'm more in line with you.
Okay, which would be about another, I think, 10% from where we are right now. At the 30.
And let's talk about this too. People don't be like scared into like this gloom and doom. I think that we've got like a much more intelligent audience than like the general Main Street investors. But I was talking to a user yesterday, a Benzinga user yesterday, who said, just keep hearing for market pundits calling for a 95% pullback off of the highs. 95%. He was so convicted in this 95%.
On like the SPY?
On the SPY. I'm sitting here thinking, I'm like, if there's a 95% pullback, I'm just going to buy Target. Like, I'm going to buy the whole fucking company.
To put it into perspective, I think we topped out at like 475 on the SPY, so 95% from there would bring us down to like $8.
Yeah, yes. we're not getting a 95% pullback. I think where you're at with like a 3,300 or something like that is much more reasonable.
But with that said, with the doom and gloom, so I have pulled up the AAII, the American Association of Individual Investors Sentiment Survey. I don't know if you already saw this, but do you have a guess for the week ending yesterday? So the last 7 days, kind of percentage-wise, it'll give us a percentage for how many people, these are individual retail investors, percentage are bearish versus neutral versus bullish. Let's just make it easy for you. Why don't you just guess what percentage of people are bearish right now?
Individual investors?
Yeah, so not like institutional, but
do we know when the survey was taken?
Yes, in the last week. So in between.
That was a bad week.
Yeah, in between last Wednesday to this to yesterday.
74%.
Nope, a little bit lower than that. I'll show you. So this will give us 60.9% bearish. Compare that to the week prior, 46%. So a 14% uptick. You went from seeing 26% people were bullish the previous week. This past week, only 17. So less than 1 in 5 retail individual investors is bullish.
Where are you at? And I'll talk about where I'm at.
I'm in the, I think we'll probably see the markets come down a little bit further as long as don't fight the Fed, 5 to 10%. We'll see earnings coming out. I'm not in the doom and gloom bearish camp that I think we're going to see some sort of like 07, 08 type housing market crash and stock market collapse and all these things. So I'd say I'm probably more in the neutral camp. I'm definitely more bullish than probably the average person. Like I think we're gonna be fine. I think like I'm still adding every 2 weeks, Luke. When you give me my paycheck, still 10% of that is going into my like investment accounts and buying the S&P 500.
Yeah, I was just about to ask you about ETFs.
Yeah, and if I really thought like we're about to crash, then I would turn those investments off. There would be no point in making them if I thought we were going to crash 50% from here. But I don't, so I'm okay with buying those ETFs, knowing, hey, it's realistic that I'm going to be down. Bless you. I'm going to be down 5-10% on them in the short term, but I'm going to hold them for a while. Bless you, and be okay.
All right, no, I'm good. You can never sneeze once. You always have to sneeze twice.
Love it. But another reason I was bringing this up was this is the 1 year bearish high week ending in 9/21/22. That was yesterday. So this is the most bearish retail investors have been all year. We know sentiment follows price a lot of the time, but it's surprising to me that even we're more bearish now than when we were hitting those lows in June. Is that surprising to you?
No, not really. Because of the change in macroeconomic story, and I put myself, and when I say the macroeconomic story, I'm thinking about like the
inflation hasn't really topped out.
The Main Street story. Businesses are starting to feel it. There's no doubt.
Yeah,
there's no doubt.
100%.
And the stock market always leads the economy. Not always. I think pretty damn close to always. I hate making sweeping generalizations. There's going to be a lot of people who say that isn't the case and the stock market is so out of whack. But more or less, the stock market leads the economy, right? You've got the most significant amount of wealth to be made, and you got the smartest people doing it. You can be a hater on that as much as you want, but that is the reality. We look at recent past, okay? COVID starts happening. Stock market sold off before we started shutting down businesses. COVID wasn't as bad on the U.S. economy as we all thought it would be. Stock market ripped before businesses started making more money. Right?
Yeah.
Stock market started selling off before the real business impact was felt of current economic situation. And here's where I see that change of sentiment is not super surprising to me. This is anecdotal, but similar to wider spectrums of data we've collected on Benzinga last night. So I'm the chair of a board of a local Detroit charity. We had our quarterly board meeting last night. It's basically a dozen business owners that are there. Small business owners, mid-sized business owners, but about a dozen business owners. Everybody said that they started to feel it, and they were not feeling it over the summer months. Just when we met 2.5 months prior. Nobody was feeling it yet. Stock market had already started correcting at that point. Nobody was feeling it yet. We're like, what the hell is this? Right? Now everybody's starting to feel it. And that's part of what puts me into the neutral camp. And I saw somebody in the chat saying that they're not starting to buy the dip yet. They're waiting for 3,200. I am buying the dip a little bit, but I'm still very cash heavy. I'm still about 25% cash. I've got about 50% that is in ETFs, and then about 25% in individual equities. And it's in those individual equities that I'm buying the dip a little bit. I am fearful of getting caught in a value trap. Do you know what a value trap is?
Yes.
Okay. Should we explain it or no?
I think I kind of explained it earlier where we were looking at, I was saying like
Baba.
We can talk about Babo, but I was looking at like AMD and looking at, oh my God, it looks so cheap right now with exactly. the PE. But then if they put out earnings that's lower than that essentially that's the value trap, right?
That's the value trap.
Is that once the earnings start coming in, but once the earnings start coming in lower, it's calculating basically based off of earnings from AMD's best quarters, the past 4 quarters. And if those numbers start to come in lower, the PE, what it is now, isn't really reflective of the current business.
Yeah, and in my take is still avoid anything that's real estate or construction like the plague. I actually think you avoid industrials, believe it or not. We can talk about that for a second. I think that it's really big cash flowing tech, and I think that it's banks. I
think once we do start to feel the bottom coming in, you do, and cash flowing tech is certainly one of those. You start to look at some of these names that have really been beaten down 75, 80%, right? Your Netflixes, your Rokus. I think those are I didn't type in something right. I was like, Netflix is not down 13% today. And you've already started to kind of see that, right? Netflix has been showing relative strength against the market, and it is a cash flowing big tech company that drew down 80% from top to.
It's a great example.
You know, a lot of value investors were coming in and
example.
buying Netflix here at 180. But Luke, to your point, which I think is great insight, kind of some like behind the scenes things when you're talking to these business owners, and as someone who essentially runs Benzinga understands how this company operates and maybe how things may have been a little bit more difficult over the past couple months compared to 6 months ago or whatever. But the glass half full way that I'm thinking about that is that, you know, a lot of the things we're looking at are lagging indicators. So maybe we'll start seeing, like you're talking about, these business owners struggling. We'll start to see some of those numbers coming in that businesses are struggling a little bit over the last couple months. We'll start seeing that. And then we haven't, essentially the Fed hasn't seen that, right? You heard Powell talking about that they haven't really seen wage growth start to come down, haven't really seen unemployment start to tick up. So as more people feel that pain, we will start seeing more of those numbers. Okay, now the Fed does have a dual mandate. We'll have to kind of balance that, figure out, okay, how can we, keep businesses from having to lay off half their staff, all these things. So the more that essentially people start to feel that pain, the closer we are, I think, to the Fed having to come in and say, we got to do something.
Yeah. How much more aggressive do you think the Fed is going to be
to bring inflation down?
Yeah.
We'll see. We'll see if inflation keeps growing from right now, then they'll have to start doing 1% hikes until the rate gets up to 7-8%.
We're getting another hike.
Yeah, but to the severity of it, I think
we could be one and done. I think there's a real reality where it's one and done.
Just one more big hike and then done.
Yeah.
1% and then be completely data dependent.
Yeah, or 3/4.
3/4 and then be data dependent. I wouldn't mind that. All right, let's talk some individual names. We did talk let's talk some Baba. Down another 1.5% today. Are you putting Baba in the same camp as
No.
construction and
industrials and homes?
Avoid it like the
real
plague.
Estate?
Yeah, avoid it like the plague.
Nah, I just think it's a good YOLO. It's a major YOLO.
Man.
Like, there's no reason that you should be buying home builders right now. You agree with that? There's no reason that you should be buying home builders right now. Baba, there's a case to be made. It's a major YOLO. What are we? Are we at new lows or are we just off the lows?
We're just off. So in March 22, we hit lows of, we got down to 73. We're at 80 right now. We've hit this spot, though. It looks like 1, 2, 3, 4, 5 times we've basically been at this point over the last year. Hasn't really gotten much lower than that, right? We got down to 73 here in March. But if we start to get to down to 70, I promise you guys, and I'll say this publicly, I will put my money where the mouth is. I will make a big long position if we get down to $70 flat on Baba.
I would do it too. Should I say Baba? Why?
Why? Because this is the biggest company in China. It's been beaten down. It's down here. Let's try to guess. What do you think?
The stock is incredibly cheap at this point. There's no doubt about that.
From a value standpoint, we don't want to get caught in a value trap, though. Remember.
Yes.
What is your guess?
And Shelly brings up the point. Here's why it's not like, if somebody were to say to me, okay, here's a real text I got from my cousin a couple weeks ago asking if she should buy Netflix. I said, sure, go for it. I own a decent chunk of Netflix. It falls into that nice big cash flowing tech that I think we see first rotation back into. Baba, I don't feel the same way about, because exactly what Shelly's saying. It is the Chinese government's poster child of control.
No, she's saying it isn't.
Oh, okay.
I disagree. I disagree.
Well, okay. She's making the statement that the Chinese government loves to beat up on Baba.
Yeah, but the Chinese government loves to beat up on Baba, but the Chinese government's first priority is becoming the economic powerhouse of the world. It's going to do so through its biggest companies.
Tell Didi that.
What's the PE?
I still have that trade on.
Mike's asking. Forward PE on Baba is 10. Price to sales is 1.8.
Yeah, it's a cheap stock.
What value is the premise? Yeah, value is the idea here. What's your guess, Luke?
I have the DD 7.5 put still.
Peak to
up 94%.
Peak to low on Baba. What's your guess?
What do you mean by that? What percent is it down?
Yeah, what percentage wise are we down?
Oh god, 75-ish.
74.06.
Yeah, that's pretty good.
74% we've drawn down on one of the biggest companies on a basically my bull case on it. Yeah, there's a lot of value baked into here, but my bull case is basically, and it hasn't really changed, is it's a fucking huge company. It's gonna be around, and the Chinese government, for how much they've cracked down, for how much they've shown they're willing to do, I don't think is going to follow through on, like, I think the fear essentially is bigger than what's going to actually end up happening. I think
so too.
Yeah.
It's a major YOLO. I'm not a hater of the idea.
But I was talking about it yesterday. Luke heard me talking about it yesterday on the stream and then sent me a message last night about, that was in the Hong Kong market? Something happened?
Yeah, that was the Asian market open.
But hey, now we're only down 1.5%, so not too bad in the grand scheme of things.
Are you already in the stock?
Honestly, I don't think so right now.
Okay.
But
right,
like I said, I don't know how I'm gonna go low. I'll go either, buy some stock, or I'll buy some leaps or something. My spidey senses are starting. Like, I'm not bullish here on the S&P 500, but like seeing that retail has gotten the most bearish it's been all year now, like it's getting my spidey senses are starting to tingle that it's starting to get time to the old Warren Buffett adage, you buy when others are fearful, you're greedy when others are, or what is it? You sell when, I don't want to butcher it.
You get it. We all get the point.
Yeah, but I don't want to
buy when people are fearful, sell when they're greedy. You pulling up the exact quote? Be fearful when others are greedy, and greedy when others are fearful. So right now, this is Warren saying, hey, it's time to be greedy. We'll see if he puts his money where his mouth is. I'm curious to see, once this quarter's over, his filings, to see if he was like adding to his positions or not. Yeah. Here's the other thing that I definitely wanted to talk about, is tax loss harvesting. If you guys have losses, harvest those. I've captured a lot of tax losses so far this year. Wait, I want to ask you something. Like maybe like 300,000 or so. don't it's say a lot. Don't say how much. It's a lot. You're doing. But that's free money. And the way that you do it is, let's say you own SPY and you're way down on SPY, just rotate it into like the Vanguard large cap, something that tracks a different index. So, okay, so basically you get the tax benefit and you haven't had to change your position at all. Here's what I want to know. I was going through my managed account the other day, and I was looking at recent activity. I was trying to get inside the mind of an FA right now, of a financial advisor, seeing what they're doing. Is this a tax loss type move? Let me try to find it. So, okay, sold. Let me try to find this. I gotta find the exact right one. Oh, okay, here we go. So he sold the real estate select spider ETF, sold that on the same day, bought the Vanguard real estate ETF. Wait, give it to me one more time. Okay, so on the same day, on September 13th. We sold the Spider Real Estate Select ETF. I don't know what that is. For a loss? You know? I don't know. Okay. All right. You just know you did the trade. I just know we sold it, and then we bought the Vanguard Real Estate ETF. Yes. That's called tax loss harvesting, baby. So if I text him like a screenshot of this, and I'm like, hey, nice tax loss harvesting, he'll be like... Yes. That's the move. But didn't you say it has to be a different benchmark? It probably is a different benchmark. The real estate ETF from Spider versus Vanguard? Yeah, they're probably slightly different indexes. They have like one different constituent. But outside of that, it's the same thing. It's the same shit. All right. So he knows what he's doing. He knows what he's doing, yes. All right, good shit. I'll text him and be like, Rob, good shit. Yes.
All right. Hey, any questions for the chat while we've got Luke here? We've got about 9 minutes left on the show, but there's no show after us. So if we don't have anything, we can wrap up a few minutes early. But any final words, thoughts from you?
Yeah, again, like let's go back to where we started. I'm sitting in this neutral camp a little bit. I still am absolutely tax loss harvesting, especially in weeks like these past couple weeks that we had. The calls for a 2,900 in SPY I think are overdone. I think AB's 3,300 is much more reasonable, and be selective. You know, I'm not waiting to buy the dip. I don't have any positions that I'm going to be adding today, but I've already bought the dip a little bit. And again, it's been some of these nicely cash flowing big tech stocks. You know, still have decent earnings projections, trading at very reasonable values, and again, highly cash flowing. And that's how I'm handling it.
Hell yeah, man. And yeah, just for some context, again, I'm not saying I'm bullish, anything like that, but as we get down here again, so S&P 500, we hit around 30. This is the SPY, so around 363 in June. If we get down to around that 3,300 level, that will basically be where we were at pre-COVID crash. The level some people are calling for, we talked about 2,900. That would bring us down to about halfway down on here on the COVID crash. That would be a very drastic move from where we are at now. We shall see. But again, I think Luke and I are in agreement here. We're probably both more short-term bearish to neutral. All
right, and Israel just came out and said they received a credible military threat from Iran.
Who was talking about LMT earlier? Maybe you should buy some. What do I know? I don't know.
LMT is probably a decent trade.
Yeah, there are all these geopolitical tensions ramping up. If you want to buy some LMT or some Raytheon, yeah, I don't know.
I think there's a decent chance that China does invade Taiwan.
You think there's a decent chance China invades Taiwan? Well, our Baba trade would get blown the fuck up then. Like that's one of the things that I'm betting against going long.
Yeah, I mean, I'm not saying it's a screaming buy.
Shelly thought you meant Israel.
Oh, no.
How's Spence doing?
I don't know. I haven't talked to him in a little bit. I'm sure he's fine.
He's getting ready for his wedding.
Yep.
If you guys, Spencer at benzinga.com.
That was the best. What we used to do is he would get so pissed when we'd say his email address on the air, and somebody would do it like every day, and you guys would blow up his inbox. It was amazing.
It was the best prank ever.
Wait, who else could we do that to? That would be a good one.
Someone that would actually get upset, because I was gonna say Renato, but I feel like he wouldn't even get upset. He would just be like, "What the heck? Why are these people emailing me?"
Yep.
Also, it's funny because they knew Spencer. I don't know.
All right, how about this? Let's do this fun one. Does anybody want to enter to win a free Benzinga Pro? Have we done that in a while?
If I draw on my laptop with a Sharpie, will it come off, AT? Okay. A free Benzinga, a free annual subscription to Benzinga Pro.
I was gonna say a free month.
A free month? Yeah, we can do a free month.
I mean, have we done that recently or no?
No.
Been a while.
Andrew Weiss got mad at me. Yeah. Baba Puts might be better. What I'm saying. Oh, Neil. Yeah.
Oh, that's so good.
That is good.
That is so good.
All right, email Neil.
No, we can't do Neil right now.
Not right now. He's got busy things.
Yeah, we're having a tough day today.
All right, we'll keep brainstorming the crowdsourcing the pranks. Guys, smash the like, subscribe to the channel if you have not already. Smash the like for Luke taking time out of his busy day to hop on with us. Always a pleasure, Mr. Jacoby.
Always happy to come on. This is literally one of my favorite parts of the week. I used to love doing it every day.
It's
and
one
some
of
things changed. I don't get to anymore.
Doing the show every day. This is probably my favorite segment. Both because it's you and you're one of my good friends and good to have you on. But also I like having in-person guests on. I think it's more fun having a conversation.
100%.
With someone than having to do it virtually.
Way more fun. You're a good friend, AB.
You're a good friend as well.
All right, pro.benzinga.com. Start the 2-week free trial. Help me out a little bit. I would appreciate it. pro.benzinga.com. Link is in the chat. Happy trading, everyone.
Peace and love, y'all. We'll be back tomorrow. Till then, happy trading and stay great.
Did you know nearly all stock price changes of 10% or more result from a single news headline? That's right. News headlines have a unique ability to drive stock prices up or down. These news catalysts create trading opportunities every day. All you need is a little help to reach out and take them. And if you're looking to grow your portfolio, it doesn't matter if your investment budget is small or big. An easy-to-read stream of news headlines will increase your opportunities to profit from price changes in the stock market, consolidate a knowledge-based investment strategy, and grow your portfolio. All you need is Benzinga Pro and its powerful news alerts, price tracking, and portfolio monitoring to make a positive change in your trading performance. We've already helped thousands of retail traders across the world, and they could not be happier. Increase your market knowledge,